Hi, welcome back. The last two sessions, we looked at the case made for passive investing. And the best case for passive investing actually is made by active investors. We looked at individual investors and we looked at mutual funds. We looked at hedge funds. Essentially, we looked at the active investing universe and came to two conclusions. One is the typical active investor doesn't beat the market. And second, you can't just blame the bad active investors. It's actually a collective problem. There are very few consistent winners in active investing. Now, you might decide that in spite of that poor track record, that you might be able to succeed with active investing and go for it. And I would encourage you to do it. So if you think you can be a successful active value investor, give it a shot. But if at some point in time you decide that active investing is not paying off for you, or is not going to pay off for you, then you might decide to come back to passive investing. And when you decide to come back to passive investing, here are the three choices you will face on how to invest passively. The first is classic index funds. They've been around a long time, they've an established history, and the choices have proliferated. Okay? So when we talk about index funds, it's not just the S&P 500 anymore that's indexed. There's pretty much every index that you think of, every group of stocks you can think of in the world, there's probably an index fund for it. Here's an addition to the mix, enhanced index funds. These are almost an oxymoron because an index fund tries to track the index, and enhanced index fund tries to track the index and deliver extra returns. It's like having your cake and eating it too. And finally, you have exchange traded funds, which are actually like stocks. You can actually buy the funds like you buy shares in a company, and there are pluses and minuses of that. So let's look at the choices. Let's start with a classic index fund. In a classic fully indexed fund, here's what you do. You take an index you want to replicate. You take every stock in the index. You look at what the market cap of that stock is in that index, and you try to create a market value weighted portfolio that replicates the index. So if this is the S&P 500, you're going to have exactly the same 500 companies in your index in exactly the same proportions they are in the S&P 500. The advantage of a fully indexed fund is that once it's created, it's maintenance free. It's maintenance free as long as new stocks don't enter the index and stocks don't leave. It's self-correcting. If a particular stock doubles in value in the index, it's also going to double in value in your fund. So the transactions costs of maintaining a fully indexed fund are very small once you've created the fund. Now that's a fully indexed fund, and for smaller indices, it's usually what's done. But let's say you want to create an index fund for global stocks. There are 40,000 global stocks you might not want to buy, or you might not be able to buy all 40,000 stocks. So what you do is create a sampled index fund. Here you sample an index, which is a very large index, and you try to create something that looks like the index by creating it. And the sample has to be both random and weighted, which is kind of tough to do, but if you can pull it off, here's the way you measure to see whether a sampled index fund is a good index fund. It's not in terms of returns. You don't expect to invest in an index fund beating the index. A good sampled index fund should have a very high correlation with the index. In fact, you'd like the correlation to be 100%, but it's not going to be. Because if it's sampled, there's always going to be some noise, but that's what you will use to measure how good an index fund is how much it moves with the index. Now, to show you how much indexing has become part of investing, all you have to do is go back to the 1970s when the first index funds were created and track their growth through time. The very first index funds were S&P 500 index funds. So the Vanguard index fund that's still used as the benchmark was on the S&P 500. And initially, all index funds were S&P 500 funds, but they were a small piece of a very large market. Most investors still chose to invest in active funds. Over the last 40 or 50 years, index funds have clearly got a very large foothold in the investment market. And not only have they become much larger as a percentage of the market, the number of choices has proliferated. So now if you go to the Vanguard side, you will see dozens of index funds indexing pretty much everything on the face of the earth. You want to create an index fund for emerging markets, you go ahead and on Vanguard, they have an index fund against emerging market companies, against US companies, small companies, large companies, value companies, growth companies. So essentially the choices have increased and the amount of money invested in index funds has also gone up. And I think the reason it's happened is not because these index funds are out there marketing and selling themselves. It's because investors have been burnt on active funds so much that they often migrate back to index funds saying, why would I pay that big transactions cost and big management fee when I can get higher returns often by not paying either of those things? But now let's look at the alternatives that have opened up to indexing. I want to start out with exchange traded funds because, in a sense, exchange traded funds are the fastest growing alternative to traditional index funds. They allow you to essentially buy different indices of pretty much whatever you want, not just stocks, but bonds and commodities, and essentially do it just like you do shares. So it's actually very easy to transact with exchange traded funds. We'll talk about index futures and options, how you can use those to create index-like returns. And thirdly, we'll talk about enhanced index funds and how they get enhanced and what makes them enhanced in the first place. So let's start with exchange traded funds. Exchange traded funds, you get the benefits of being invested in an index with the liquidity of a traditional stock. So you get prices updated every minute of every day. There's a symbol for the exchange traded fund. You can buy the fund, you can sell the fund. And while the costs of running an exchange traded fund are usually slightly higher than the cost of running an index fund, the trade-off might still work for you, especially if you have shifting asset allocation mixes. So if you want to have 20% of your money invested in emerging markets this year, but might want to shift that to 5% next year, an exchange traded fund might be more economical for you because it might be easier and cheaper for you to shift your exposure with exchange traded funds and with index funds. Now, what about enhanced index funds? Enhanced index funds basically take a traditional index fund and try to tweak it. The plus of a traditional index fund is you replicate the index. The minus of a traditional index fund is you replicate the index. You're saying, so what? If you're an investor, you want to beat the index, right? So if I came to you with a product and said, look, I'll create a fund that looks just like the index. So you don't have to worry about me going out and doing crazy things. I'm going to track the index, but I'm going to tweak that fund a little bit so that you get a little more than the index. And I'm not going to make you greedy. I'm going to say, look, 0.25% more or 0.5% more. And there are three ways I might be able to create these enhanced index funds. The first is, remember we talked about options and futures being available on indices. If you look at the range of derivatives that are available in indices, it's conceivable, though not highly likely, that by combining the derivatives with some borrowing or lending, you might be able to create something that looks just like the index, but delivers slightly higher returns. For this to happen, there's got to be some mispricing somewhere. Either the derivatives have to be mispriced or the transactions costs are not reflected fully, but you're taking advantage of a market friction to generate higher returns than on an index fund. The second kind of enhancement strategy, you adopt a more conventional active. So basically what you do is you start with the S&P 500 and you basically try to decide which 450 out of the 500 companies you will have in your portfolio. In other words, you shed those stocks in the index that you think are the worst stocks, which effectively means that you're creating an active portion to your strategy. You're trying to find cheap and expensive stocks. In fact, in some versions of these enhanced index funds, what people do is they take the findings from history. Small cap stocks have earned higher returns than large cap stocks. Low price to book companies generate higher returns than large, and they try to introduce those inefficiencies, for lack of a better word, into their enhanced index fund. And they say, look, it'll look a lot like the index fund in terms of return, in terms of standard deviations, because I've got 450 out of the 500 companies, but because I've taken out the 50 worst companies, your returns are going to be slightly higher. So those are tilted fundamental index funds, if you can even coin such a term. And finally, there's a third version of an enhanced index fund where you go back to portfolio optimization. In the immediate aftermath of Harry Markowitz coming up with that risk-return trade-off and the quantitative tools coming into play, people got really excited about what was called mean variance optimization, which is you tell me how much risk you want to take. I'll find you the optimal mix of stocks or risky assets in the sense that these are the assets which will deliver the highest expected return for your given level of risk. There are people who actually take all of the 500 S&P 500 companies, plot out the expected returns and standard deviations on each of the 500, compute the correlations across these 500 companies, and then put an optimization strategy to play, which is for any given level of risk, they try to find that combination of the S&P 500 companies that delivers the highest expected return. So in other words, you're still staying true to the index fund concept, but you're trying to find that subset of the index that will deliver higher returns. Now that's all nice, but I also would argue that many so-called active funds are really enhanced index funds. And the way to see this is you take a fund like Fidelity Magellan, one of the larger active funds out there. This study actually looked at the active share of that fund. In other words, how much of this fund was driven by active choices, going out and finding cheap stocks? In 1980, for instance, 96% or 97% of the investments in this fund were looking for cheap stocks, activity in search of higher returns. As the fund got bigger, and these are different money managers, even under Peter Lynch, by the time you got to 88, only 60% of the fund was actively looking for bargains. The other 40% was almost indexed. And as you go through the 2 years of Morris Smith, the 4 years of Jeff Weinig, and then Robert Stansky in particular, by the time you get to 2001 or 2002, 65-70% of the fund is being picked on an indexing basis. It's only the remaining 35% that's active. And that could be said about a lot of so-called active funds, especially the larger funds. They're really index funds because they hold so many of the stocks in the S&P 500 or the largest market cap stocks in their portfolio. It's very difficult for them to bring in their activity into their returns. It is interesting, though, that even big funds can have rebirths. As you can see, in the last 5 years, Fidelity Magellan has become, again, a much more active fund in terms of seeking out bargains in the market. Being more active is not necessarily a good thing if that activity doesn't pay off. But if you're an active fund, you're selling yourself as an active fund, you're collecting my fees on that basis, then it's really not fair to me if you end up being mostly an index fund with a little bit of activity. Now, if you look at enhanced index funds, the promise that they offer is that they will generate higher returns than on the index. So this is from an old study, and I just want to illustrate a point, which is they do deliver returns higher than the index, but don't expect miracles here. Because they so closely track the index for the most part, the additional returns you're talking about here are 30 basis points, 50 basis points, 0.5%. Now, if that. So you're talking about relatively small additional returns. You're saying, I'm okay with it. But here's the catch. Many enhanced index funds also have slightly more risk. So that's why I think calling them index funds is an oxymoron. They're really mildly active funds, and that might be a good thing because we've seen that mild activity is better than heavy activity. So I would actually put up enhanced index funds in the big active fund column because, as I said, most of those big active funds are really enhanced index funds the way they're run. And if you're going to invest in one of these funds, do it with open eyes, which is they're going to be slightly more risky than the index for the most part because they're not as diversified. You've taken out 30 or 40, 50 stocks out of a group of 500, and you might make slightly more returns than a typical index fund. But it seems to me to be, there's not much here, to be quite honest. Something to get excited about because, in a sense, these are really neither active funds in the traditional sense, nor are they passive index funds. They try to straddle the difference, and often by trying to straddle the difference, you don't become very good at either. So in summary then, if you look at if you decide to go the passive fund route, your choices have proliferated. 30 years ago, if you wanted to be a passive investor, I'd have said go out and find a good index fund, and maybe there are only 3 then, and put your money in those 3 index funds. Today, if you ask me what should I do, I'm a passive investor, I will offer you a menu of choices of different index funds, different ETFs, maybe even enhanced index funds in the mix. The objective being find the mix that best fits you, where you don't have to be active. You don't have to pick stocks. You have to allocate assets still. But that asset allocation should reflect the desire to be diversified more than anything else. Because, unless you want to be a market timer and try to time markets, you're not picking an ETF because you think that that particular index is cheap or expensive. It's to bring exposure to that risk into your portfolio. That's about it. Thank you very much for listening. And I hope you end up being an active investor. But if you decide to become a passive investor, I won't think any less of you.